Can you do a 1031 exchange into a REIT? Thinking about selling your property and then investing to be passive in a REIT? Be careful. Most real estate investors don't realize that you cannot 1031 exchange into a real estate investment trust. But there's a workaround. I'll explain how. A lot of people want to trade active income or active real estate management by getting into a passive vehicle like a real estate investment trust, a REIT. But here's the catch. A 1031 exchange does not work for this process. But there is a process that does work, and it's called the 721 exchange. By the end of this video, you'll know that you cannot 1031 exchange into a REIT, but you will understand how to utilize the 721 exchange, where you can go from active management of real estate and selling your property to a REIT with a 721 exchange. This allows you to be active to passive and still defer capital gains, now receiving income from the REIT. So what's a 1031 exchange and why do REITs not qualify? A 1031 exchange allows you to sell an investment property and reinvest in another like-kind real estate to defer capital gains taxes. The key requirement is that the property is like-kind. This means investment real estate for investment real estate. Check out other videos I've done about what a 1031 exchange structure is and what properties qualify, but I'll give you a quick overview. It does not qualify for buying crypto, buying stocks, buying shares in a REIT, or buying shares in a partnership. It also doesn't qualify for securities, treasuries, bonds, none of that. It has to be real estate for real estate. It also doesn't qualify for residential housing that you're going to be living in. When you look at it that way, then REIT shares are considered securities, meaning they're stocks, and you cannot 1031 exchange from a property into a stock or a REIT share. But the 721 exchange is the strategy, and this is what makes it possible. The 721 exchange is also called an UPREIT, an umbrella partnership real estate investment trust. Nice long definition there. It allows property owners to contribute their real estate into a REIT's operating partnership in exchange for OP units, not the REIT shares initially. Now, these OP units can later be converted into REIT shares. This essentially allows investors to achieve the same goal. They can sell their asset and in return get OP units instead of cashing out and then having to buy shares from the REIT. I've been through this process before. I have a portfolio of storage facilities around the country, and one of the major storage REITs approached me about buying some properties. It was an attractive proposal for me because I did not want to pay all the capital gains tax or the recapture of depreciation. Instead of having to pay the tax, I looked at the offer of receiving OP units in their company that I would be able to defer taxes and ensure that I got a passive income. Now, all REITs are different, and there's many different structures of OP units and how to convert them into REIT shares, but they gave me essentially two options. One was the OP unit was set at a fixed dividend. Say it was an 8% dividend that I got for the rest of the life that I owned the OP unit. But the catch was the value of the share or unit never went up. It was fixed at the price that I received at the time of the sale. The alternative was getting OP units, but quickly converting them into the REIT share. That would allow me to participate in the upside or appreciation or downside in the stock, and I would get the traditional stock dividend, which is anywhere between 3 and 4.5%. Why is this helpful for real estate owners? Well, real estate owners typically are actively investing. And when they're actively investing, you have to manage property. At some point, it's not fun to manage property anymore. If you as an investor are tired of controlling property and not wanting to manage, then selling to a REIT, if your property qualifies and meets the standards, is a good option. Selling to that REIT gives up control, but you no longer control the asset and you no longer have exposure to that one property. You're now participating in all of the property's performance within the REIT. So if that's an option, you want to be sure that the REIT qualifies for your investment criteria and that you like the leadership and you believe in the performance of the REIT because you're giving your equity or investing that equity into the REIT and you're going to be participating from the profits of those shares. So how a 721 exchange works, step by step. Step 1, you contribute your property to a REIT's operating partnership, the OP units. Step 2, you receive OP units, and this is representing equity in the underlying portfolio. You are now a fractional owner of all the properties that they own within the REIT. Number 3, capital gains taxes are deferred at this stage. Number 4, you can convert those OP units into REIT shares. You have to talk to your tax advisor if that's a taxable event or not. Number 5, Once converted, your investment becomes fully passive and liquid, where you can sell off REIT shares if you'd like to get some cash back, or you can participate in the dividend yield that they pay out every quarter. This strategy is perfect if you're an investor that owns REIT quality assets and you want to start to be passive, having long-term stability and income coming from a qualified professional operator. And then, most importantly, you can get liquidity. You can start selling off REIT shares as you would like to get cash back in the bank. For me at Patriot Holdings, I have a storage portfolio called All-Purpose Storage, and someday I may utilize this strategy. The market is challenging for real estate investors in 2025, yet when there is the time for me to sell off the entire portfolio, if I choose to do that, then selling to a REIT and doing a 721 exchange could be advantageous for my investors because we can defer taxes. Not every investor would have to make that choice, and some investors could decide to cash out, but other investors could choose to exchange their equity or their appreciation and their capital into these OP units and eventually into the REIT ownership shares. That's going to be an exciting day, but for now, that option's not on the table. So what are the pros and cons of the 721 exchange strategy? Well, the pros are it's 1031 exchange type tax deferral. You are now deferring tax into the future and being able to reinvest into a new asset without paying that tax. Next, you're diversified across a large real estate portfolio. You no longer have exposure on just your asset. You own a bucket of assets. You create liquidity through REIT shares. You can sell off a portion of your shares and have cash and still have exposure to real estate by keeping shares in the REIT. No more active management responsibilities. The REIT manages the property. You are out and hands off and a passive investor. What are the cons? Well, the transaction's irreversible. You cannot 1031 again if you invest into a REIT or exchange into a REIT. Once you're there and you sell units, you are subject to long-term capital gains tax, or talk to your tax advisor where there may be additional taxes depending on the type of income you receive from the sale of the shares. Less control. At this stage, you're giving up control and the REIT manages the property. Next is you must work with the REIT's offering of OP unit structures. So it might not be advantageous if the OP units are highly valued above what the current stock price is. Next, conversion to REIT shares could be a taxable event. So you want to talk to your tax advisor about when the capital gains tax would be triggered. When does a 721 exchange make sense as a real estate investor? Well, you want to eliminate management and exit the ownership of a property. You're looking to defer taxes and you want purely passive income. You're okay giving up control and any future depreciation. There's no more depreciation when you work with the REIT. The beautiful thing is once you exchange into the REIT, you can wipe out some of the depreciation recapture that you utilized while you owned your previous property. Talk to a tax advisor. I'm not an expert. I'm not a tax attorney on this, but that is a concept that's interesting to explore. And it's important you know that you are done doing any more deferral. Once you put your equity into the REIT, there's no more 1031 exchanges and there's no other tax advantages. It's time to own those units for the long haul or sell those units and pay your tax. I own a private equity investment firm called Patriot Holdings. We are not a public REIT. We are a private real estate fund. And I've been asked the question, can I 1031 exchange into a fund or 721 exchange into my fund? Well, the answer is not simple, but it is a yes. You can 1031 exchange into the Patriot real estate funds. We use a structure called a TIC, a tenant in common structure, where you'd be selling an asset and there's a vehicle and way to be able to participate in our real estate funds if you're 1031 exchanging out of a property you're selling. Feel free to click on the link below and you can reach out to us and explain it more in detail. And if you are an investor that owns a storage property, mobile home park property, or a small bay warehouse, there is a way to 721 exchange into our private fund structure. You would be contributing the units into our fund and in exchange get units in the entire fund portfolio of 20 assets rather than just having exposure to the asset you own now. Also, click on the comments below and we can get into a deeper discussion around 721 exchanges and selling your asset into our fund and tax deferring those proceeds by contributing the asset in Patriot. The point is there's many ways to defer tax where you as an active real estate owner can now be a passive investor. And as long as you're aligning with the right real estate partner, there's a vehicle that can take the equity you have in an existing asset and reinvest it into another stabilized passive asset or bucket of assets. That's our goal at Patriot, is to help solve creatively tax problems so that investors can compound their wealth, and defer taxes. So now that you know the basics of a 721 exchange and the fact that you can't 1031 exchange into a REIT, I'm sure you're going to have lots of questions around what can you 1031 exchange into and how do I find the right property to do that? Well, check out this next video about 1031 exchanges. This will be everything you need to know about qualifying, what properties you can buy, and what are the rules in order for you to defer taxes and find the right investment asset that fits your portfolio. Thanks.